So today I want to talk about not necessarily what the market might do in the next couple of months, but what the market normally does over the next couple of months. One thing that I've learned throughout my career, actually I've learned a lot of things and I've learned a lot of hard lessons, but the one thing that I've learned over and over and over again is during the months of November and December, the environment is extremely unfavorable for speculating or even investing. The markets do weird things. We can argue all day about why the markets behave irrationally during the holidays. It's probably mostly because of light volume. People are paying attention to friends and family and holidays and turkey and things like that. They're not focusing on the markets. The active traders that are in the markets are individuals that are probably highly speculative. So whatever the case is, the markets tend to be a little more volatile this time of year, and I've found that this is the time of the year that less is more. And don't worry about missing trades. It's far less painful to miss a trade than it is to be in a trade that goes bad during this time of year, because when things go bad, they go really bad, and that's what we're going to talk about. As a reminder, there's a substantial risk of loss in trading futures and options. It's certainly not suitable for everybody. It is highly speculative. So the first example we're going to talk about is the S&P. Again, the premise of this video is the S&P does really wild things. In fact, it's not just the S&P. Every year it seems to be a different market. Sometimes it's a couple markets, sometimes it's only one. Could be commodities, could be treasuries, could be currencies, could be the stock market, but at least one and sometimes a handful of markets choose to be extremely irrational during this time of year. Here are a couple of examples in the S&P. In late 2017, a holiday rally extended into January that spanned nearly 400 points in the S&P. Some called this the Trump bump, some called it the tax cut rally. Whatever you want to call it, it rallied at a pace that I would argue we probably have never seen before. And the odd thing is it rallied from a high, elevated price. Usually when you see the stock market rally extremely quickly, we're coming out of a trough. In this case, it started from a peak and skyrocketed higher throughout the months of November and December, and it actually went into January. My argument is a lot of this rally was simply thin holiday markets, shorts getting squeezed out, the buy stops getting run, fear of missing out. Everybody that hadn't been in the rally before and now realized the market's moving and they're missing out, were scrambling to get in. So there were a lot of people buying that didn't have to buy. Or I'm sorry, they were buying because they had to buy, not because they necessarily wanted to buy. Sometimes emotions take over, and that's exactly what happened in 2017. S&P rallied 400 points, and almost immediately, once we got into the next year, it gave the entire rally back. We saw the opposite happen last year in December of 2018. The S&P dropped from roughly 2,800 into the 2,300 area. So we're talking over 500 points in the S&P. If you're a futures trader and you're trading a single E-mini S&P, this move was roughly $25,000 to $30,000, depending on where you pick the high or low, per single contract. That move occurred in a handful of weeks on the way down, and a couple of weeks later, on the way back up, we had reversed it. Can you imagine being a person that liquidated in panic on Christmas Eve thinking the market was going to continue to slide? Or being the person that bought a little late to the party on the way back up? In fact, actually, even if you bought it, the high is on the rebound, you're probably still doing okay. But the point is, the market in 2017 probably should have never rallied as quickly and as sharply as it did. And in 2018, during the holidays, it shouldn't have fell as quickly as it did, but it did. These are price aberrations that actually, if you're on the sidelines and you're quick and you think on your toes, you might actually make some money off those. But the only way to make money off something like that is to be on the sidelines to start out with. If you're in the market, whether you're long or short, and you get a big whipsaw like that, it's pretty challenging to come out ahead. So another example is last year crude oil fell from, it actually started falling from about 77, which is up here, around $77 a barrel, but that occurred in October. So keep in mind, when I say holiday markets, I'm specifically talking about basically November and December, but on some years the holiday market chaos starts in October, so you have to be really careful with this stuff. There's no hard and fast rule that says on November 1st all heck is going to break loose. It might happen on October 20th, or so just these are rules of thumb. Obviously there's no black and white in trading, but the market started to decline in October, and at the time most people I think thought it was just a run-of-the-mill correction, which is what we had seen previously in 2018. As we now know, that was not a run-of-the-mill correction. In fact, it dropped in the months of November to December. It dropped from $70 to $40, so that doesn't even include the first $7 that occurred in October. So those of you that trade crude oil futures know that's a $30 move in crude oil, or a $30,000 move per contract. So if you were long or short one single futures contract, you would have made or lost $30,000. You might also recognize this as the move that contributed to at least one hedge fund blow up last year. I suspect there were others, but one in particular that was a high profile commodity trading advisor. It technically wasn't a hedge fund, it was a CTA, but most people recognize the word hedge fund before they do CTA. The difference is, if you're curious, a CTA or a commodity trading advisor is trading for other people, but they're trading individual accounts for other people. So if they have 100 clients, they have 100 trading accounts that they're trading. The money's not pooled together into a fund like it would be with a hedge fund. So anyway, a very well-respected commodity trader and hedge fund advisor, or CTA, whatever you want to call him, blew out his entire book on this move and in natural gas, and I'm going to show you the natural gas chart as well. So we're going to focus on the second box over here. The second box is from November through December of last year in natural gas. The market rallied from roughly $3 BTU to almost $5. And in natural gas, that is a massive move, especially in such a short period of time. It really only took about 2.5 weeks to get there. That's about a $20,000 move per single contract. So you can see how a hedge fund who might have been short crude puts and short natural gas calls might not have fared so well. In fact, like I mentioned, might have lost everything plus some. So these are the types of things that can happen during the holidays. Now, because I'm putting this video out and making a big deal about it, we'll probably see nothing. We'll probably have a boring holiday season, and that might be the case. But more often than not, during the months of November and December, traders are far better off taking it easy. If you are going to trade, make sure you're well hedged. Make sure you have protection in place, some sort of risk limit with options. Do not have naked risk exposure anywhere, even if you think it's quiet and boring. One day you'll wake up and it might not be. You can never underestimate the chaos that holiday markets bring. One time I do recall crude oil on Thanksgiving Day, and that's not an accident. I did say Thanksgiving Day. The futures markets were open for an abbreviated session in the morning, and crude oil dropped $8 to $9 in a single trading session. And it wasn't even a whole trading session. It was a couple of hours. So I also remember on the day before Thanksgiving one year, 30-year bond market rallied 8 or 9 handles for absolutely no reason. There was no news, there was no Fed meeting, it was nothing at all other than price squeezing, and somebody probably had a big position on and had to unwind at unfavorable prices, and it forced the market to do weird things. So the moral of the story is, do not take excessive risk during this time of year. If you're an investor, you may want to look at hedging your portfolio, lightening up, raising cash, or all of the above. If you're an active trader, you may want to pull it back as you're scanning the markets for trades, be a lot more selective. You don't want to just, hopefully you're not doing this anyway, but you don't want to randomly put on positions. You really want to make sure you did your homework, everything's lined up. You don't want to jump the gun on anything. And in fact, you may not want to even if you see a perfect setup, you may want to skip it because it might be even more perfect a week or two down the road. In the S&P, we saw that last year. We started to get interested in putting bullish positions on in the S&P as it was declining about a week before Christmas. And we thought, you know what, this is a weird time of year, let's just let it go. If we miss something, that's fine. Sure enough, by the time Christmas Eve rolled around, the opportunity was even better than it was when we thought it was good. So always be patient. If you're not familiar with who we are and what we do, we are DeCarli Trading. We offer futures and options trading brokerage services. We offer online trading as well as broker assisted. We'd love to have you. Our clients enjoy, well, hopefully they enjoy, weekly and daily newsletters, trading ideas, recommendations, guidance. We answer our phone, all those sorts of things. And if you want to learn more about trading in general, higher probability commodity trading is available at any major bookstore. It's cheapest on Amazon, and it covers everything from analyzing the markets, putting a trading strategy together, and understanding risk and reward and that sort of thing. Again, we're DeCarli Trading. We would love to see you or love to hear from you. Check us out on social media. We're on Twitter, Facebook, Instagram, or visit our website, decarlitrading.com. Thank you.